Welcome, everyone, and thank you for joining us for today's session, Before You Buy in Israel, a Q&A for U.S. investors navigating tax and residency issues. My name is Chaya Siegfried. I'm a partner and the leader of the International Tax Services Group at Roth&Co. Roth&Co is a U.S.-based accounting firm with offices in New York, New Jersey, Chicago, and Israel. We provide a full suite of advisory, tax, and accounting services. I'm joined today by Boaz Feinberg, a partner in the tax practice at Arnon Tadmor-Levy, a leading Israeli law firm. Boaz is based in Tel Aviv and advises on these types of cross-border real estate and residency issues on an ongoing basis. Welcome, Boaz, and thank you for joining us today.
Thank you, Chaya. It's great being here.
So before we dive in, can you briefly introduce yourself and describe to us a little bit about your practice?
Sure. So I'm a leading partner at the tax practice of Arnon Tadmor-Levy, fourth largest law firm in Israel currently. And I've been practicing tax for the last 25 years, focusing my practice on international families, high net worth individuals, usually U.S., whether immigrating to Israel, have family members immigrate to Israel, real estate investments, which is an issue that we're going to discuss today, taxation of trusts and estates, always a challenge, always interesting, and enjoying it very much.
Great. Thank you so much for joining us, Boaz. So, Boaz, this session is in response to a lot of questions that we get from our clients, from people out in the market that are interested in buying real estate in Israel. And what I thought was today we would structure this as sort of a guided Q&A. We'll start by mapping out the major risk areas that U.S. investors might encounter when purchasing real estate in Israel. And then towards the end, we'll reserve some time to take some live questions. So for the audience, please feel free to drop any questions you might have in the Q&A box. You should see a Q&A icon at the bottom of your screen. And we will do our best to answer as many questions as possible towards the end of the session. If we don't get to one of your questions, please feel free to email us and we'll respond that way. So let's begin, Boaz. I want to set some context based on what we see in our practice. And we see different types of individuals that are looking to invest in Israeli real estate. But before we even do that, let's establish some of the general Israeli real estate tax framework. What we find is that many U.S. buyers, so U.S. people that are looking to buy real estate in Israel, they come with assumptions that are based on the U.S. system because most of them already have done real estate transactions in the U.S., whether for themselves or they're in the real estate profession. And so they're familiar with how these transactions are taxed in the U.S. And that familiarity is driving their expectations for the Israeli market, but it's a very different tax regime there.
Sure.
It's not intuitive. So, Boaz, can you start by walking us through the main types of Israeli taxes that would apply when purchasing, when renting, when selling?
Right.
Tell us the types of tax, the rates, what we should expect.
Right. So I would divide this into three different categories. The
Okay.
taxes that you pay when you purchase property in Israel, taxes you may pay when you rent out property in Israel, and taxes you may pay when you sell property in Israel. Let's begin with purchasing. There is a purchase or transfer tax in Israel that is levied on any type of purchase of property, of real property in Israel. And the tax rates on transfer tax may vary depending on the nature of the property, whether it is residential or non-residential, and also based on the classification of the individual or entity that is purchasing the property. If it's non-residential, the transfer tax would usually be a flat rate of 6% of the purchase price. When it comes to residential, though, things become much more complicated. And again, depending on basically the classification of the person who is purchasing the property. So, for example, if you're a foreign resident and you're not an Israeli tax resident, then purchasing residential property in Israel, you would find yourself paying the highest tax bracket, which starts at 8%. 8% from the first dollar all the way up to $2 million. Anything exceeding $2 million of purchasing residential property in Israel by foreign residents would be taxed at 10% of the purchase price. That could vary if it's not a foreign person, if it's an Israeli resident and it's his first apartment, then the brackets are much lower. It begins at a 0 tax rate on the first 2 million shekels, and the brackets are much more spread. You reached 10%, but only when you get to 20 million shekels.
Okay.
And there's another category specifically for new immigrants, which have a special reduced rate on transfer tax, but that is only if they meet certain criteria, which we will get into as we go along. That is with regard to transfer tax. Then you have, if you rent out apartments or property in Israel, you pay rental income in Israel. And usually on rental income, if you're an individual, you may find yourself paying the maximum marginal tax rate in Israel. The highest bracket in Israel, unfortunately, and not unlike in the US, which is 37% federal, in Israel, the highest bracket is 47%, and that would not include surtax, which may even get to 52% overall. So 47% plus an additional 5% on rental income. There are special scenarios where you rent out residential property. If you rent out residential property that does not exceed approximately 6,000 shekels a month, then in Israel, you would find yourself not paying any rental tax. And if it is passive income, and it's not a business of renting out property, then you may tax the rent only 10% on the gross income of the rent. And that is instead of the 47% marginal tax rate, which you may reach, paying only 10% on the gross may be a nice reduction, but it's on the gross. That means you won't be entitled, of course, to use any expenses or depreciation. And finally, when you sure,
yeah, maybe
go ahead.
before if we could pause there for a second, before we
For
even,
sure.
I want to just step back for a second to the purchase side. So what you had said was there's a 8%, starting between 8 and 10% purchase price if you're a foreigner buying real estate in Israel. So let's
Yes,
say on a piece of property that's 1.5 million, we're looking at like $120,000 additional
correct,
tax. What about
correct.
VAT? Because I've heard some issue with VAT. Some buyers I
Yes,
see have it, some are not dealing with it. So can you talk to us a little bit about that?
sure. So VAT, value added tax, is an indirect tax, very similar to sales tax in the US. Works a little bit differently. Was created by the French,
Hmm.
which makes it
Love
not
the
so
French,
likable,
right?
right? Uh, and the current VAT rate in Israel is 18%. That is imposed by VAT dealers, those who deal in selling or providing services, and they would collect the VAT and then pay it to the government. And that would mean practically that any purchase price would maybe also impose VAT if you purchase the property from a dealer, meaning
Okay.
usually contractors or anyone who deals with selling property, you would also have to add the VAT. On the other hand, it needs to be noted that under the consumer laws in Israel, contractors would usually, when they publish the purchase price, it would usually include the VAT in it.
Okay.
But it also means that the transfer tax, if you're an individual and not a dealer, the transfer tax you would be paying would also be based on the VAT component and not only on the purchase price without it.
Okay. So but I guess the takeaway is if we're looking at a piece of property and the asking price, say, is 1.5 million, if you're buying from a dealer, then there would be VAT, but it should already be included in that 1.5 million
Correct.
amount.
Correct.
Okay. And then not necessarily from a tax perspective, but just any other transaction costs that are significantly different in Israel versus the US. Like I know I've heard people speak about the cost of attorneys there.
Yes.
For us in the US, if you're buying like residential property, it's not a big amount that we would have to pay an attorney to help us walk through the process. So what are the typical costs that people or fees that people can expect from on that?
Yeah. Yeah. So two major costs. One, I understand, is very similar to how it works in the US, and that is the realtor.
Okay.
Realtor would usually take between 1.5 to 2% plus
Okay.
VAT on the purchase price. And an attorney, which I urge you, never do a transaction of purchasing real estate without an attorney. You must have a good attorney representing you. Would usually take also a percentage of the purchase price, but that would be a reduced than compared to the realtor. It would range between 0.5% to 1%, depending on the complexity of the purchase and other factors. And again, plus VAT. Um, and I would urge you not to pay much more than 1%. And I would also urge you not to take someone who takes less than 0.5. That may mean a lot.
Just as important. So again, back to our 1.5 million transaction that we're kind of referencing. So you could be
Yes.
paying an attorney up to $15,000 on that, plus
Mhm.
VAT, which is the 18%. And then this is different than the US, although there is like a commission that gets paid to a realtor. Typically, it's the seller that's paying it in the US. So it sounds like in Israel, it's paid by the
Yeah,
buyer.
realtors are very sophisticated and they usually would take their credit from both the seller and the purchaser.
Okay.
So
Okay. Yeah. A little different than what we have here. So
yeah.
that we'll put that in the category of, the transaction of acquiring the real estate. And then you mentioned ongoing if it's being used to rent, so if it's generating rental income, so there's going to be either a tax of up to remind us what you said a moment
Yeah,
ago.
so it's 10% on the gross. That would be one way to
Okay.
do it. But that is only if it's passive. So for example, and we will maybe touch on this when we go in the webinar. If you rent out your property for short-term leases for
Mm,
2 weeks at a time, a month at a time, and not for an annual rent, then that may be scrutinized as a business,
mm.
especially if you use applications like Airbnb. And that would mean that you won't be entitled to pay the 10% gross because that would apply only to passive rental income and not to business.
Okay. So it's kind of the level of activity of managing the real estate.
That and the amount of property you own. So if you own more than 10 apartments, you would probably be looked at as operating a rental business.
Okay, so then you cannot opt into the 10% of the gross
Correct.
tax
Correct.
regime.
Right.
And then, for US citizens that
Mm.
are renting out property in Israel and maybe paying tax there, um, it would seem that Israel would have the first right to tax that income.
Correct. Correct. And that is true based on the double taxation treaty between Israel and the United States, and usually a standard practice in international tax. The country where the property is generating the income would usually have the first right to tax it. And so Israel would have the first right. That would also mean usually that if taxes are higher in Israel, that you won't be ending up paying any taxes in the United States on the rent. But again, it's not always the case. So for example, if you rent and you get the exemption on rent that is lower than 6,000 shekels a month, or 72,000 shekels a year, then you may find yourself not paying any taxes in Israel, but still owe taxes in the United States. And just to be clear, if that wasn't, U.S. citizens ought to pay taxes in the U.S., not only if they reside in the U.S., but also if they move to Israel. So that's another issue that needs to be we need to be very careful about.
Yeah, so I can chime in on the US side. Absolutely. If you're a US citizen, even if you live outside of the US, you are required to report all of your worldwide income to the IRS.
Yes.
In the case where it's property that's situs in Israel, you would be able to get a foreign tax credit to the extent that you pay taxes in Israel. But if you're not paying taxes in Israel because it's exempt in Israel, it's not exempt in the US, and you'd have to pay the taxes over here. It might be a little bit lower than your rate of tax that you would pay in Israel. And also there's disclosure requirements. Anytime you own property that generates income outside of the US, there's a whole host of disclosure requirements. So even if you don't have any additional taxes due in the US, you may be facing penalties if you neglect to disclose to the IRS that, hey, I have this piece of property outside of the US that's generating income. They want to know about that.
Yeah, yeah, sure.
So great. And now I guess, Boaz, let's talk about what happens on the disposition. What what does that look like? I mean, that's probably a little bit more farther out. People that are buying in Israel want to just hold and own it and for the long term. But I see this a lot where people, they enter into a contract to buy a piece of property, and then there's that 3-4 years of time while it's being built because they have that contract, but it's not a built property. And then by the time it's built, they'll flip it or they'll sell. So you do see people buying and selling. So
Sure.
what do the sales look, what do the tax on sales look like?
Right. So, generally speaking, on property in Israel, on the capital gain tax on property in Israel, which in Israel we call appreciation tax, you would pay 25%, not including surtax, which again may rise an additional 5%. So, practically speaking, and usually the spreads are high, you would find yourself paying 30% on the appreciation on the gain. That is true if whether you sell a commercial property or if it's a residential, and of course only if it's passive. Naturally, if you have a business and you sell property as part of your business, then it becomes a marginal tax rate and not passive 30%. If you were lucky enough to purchase property before 2014 in Israel, then on any spread that is attributable to the gain that was derived before 2014, you would not pay any taxes,
Oh,
which is a very special relief. But again, only for those who purchased the asset or got an inheritance before 2014. And it also, so with inheritance, and this is very important actually, in Israel, there is no estate tax, inheritance
okay.
tax, or gift tax, but it
Hmm.
also means that there is no step up in basis. And usually that's not always a good thing not to have a step up in basis when you're an inheritor and you want to now sell property. It may be very beneficial if you received an asset, property in Israel, real estate, residential in Israel under an inheritance, and the asset was purchased by the person who passed away many years before 2014. That would mean that there is a large chunk of that spread that would not owe any taxes in Israel.
Hmm.
So that could be a very interesting issue that people need to look into.
Interesting.
Um, Other than that, there is a possibility of getting a full exemption on the capital gain. And that is if it's your only residential apartment
Okay.
and it does not exceed approximately 4.8 million shekels. Anything above that would owe taxes, the 25% plus the surtax. And need to be aware, if you're an Israeli resident, there's no issue at all. If you're not an Israeli resident, if you reside in the United States, you will not enjoy the same exemption if you personally own a residential property in the US. So
Okay.
if you're a foreign resident and you happen not to own residential property and you have only one single apartment in Israel, then you may find yourself getting an exemption on the full capital gain, and that could be actually very interesting as an investment perspective.
Okay. So if you have real estate in the US, but it's not your residence, then that would not preclude you from the exemption in Israel?
Correct.
Okay.
Right.
Interesting. Yeah, I was going to ask that because we also have a primary residence exemption, but it's not as generous. It's only about $500,000. So it's limited. Now, I know
Yes.
when we spoke in the past, there's some interesting tax favorable locations where you can buy real estate. Can you tell us about that? Is that a favorable on exit in some, I think you had said in some of the developed territories that were outside of Israel. Can you give us a little bit of
So there's one specific issue that is very unique. Not many know about it, but Area C in Judea and Samaria for foreign residents may be a very interesting investment because basically, Israel does not have legal jurisdiction over Area C, and that means that the real estate taxation law in Israel does not apply to any purchase and sale of property in that area. That means effectively that if a foreign resident purchases property, not necessarily residential, in Area C, which is Judea and Samaria and some parts of Judea and Samaria, then he would not owe any purchase tax, no VAT, and also would not pay any capital gain tax when he sells. So that could be a very interesting perspective as
okay.
well.
So it's not just on sale, it's any of the taxes that we've spoken about.
Correct.
Oh, interesting. Okay.
Yeah.
That's interesting. Someone who thinks a little bit out of the box and doesn't need to be in one of the big cities, that might be an interesting
Yes.
idea.
And you don't necessarily need to move uh, to Area C. This could be an investment. So,
If it's an investment.
sure.
Okay. So that might be an interesting investment opportunity for anyone who's looking to more so to invest in Israel as a portfolio move than, personal move. But I think that's a good segue to talk about some of the scenarios kind of that we see of different types of people that want to move to Israel. And so I'll give you a little bit. I think it falls into three main categories. So we'll walk through it like that.
Sure.
The first would be what I would say like a financially successful family in the US, a couple, let's say we'll call them the Kleins. They're interested in buying a second home in Israel. Maybe they're going to use it for a holiday or as a base when they're visiting family. Um, Very often it's mixed use, meaning since they're not planning on living there full time or spending more than a couple of weeks here or there, they want to rent that out when they're not using it. So, are there any tax saving opportunities available in this scenario?
So I'll tell you, you actually found the worst case
The
scenario.
worst case.
The worst case. Transfer tax on foreign residents, as we said, 8% at the minimum. Then you also have the problem with the rent. If you rent out your apartment at, let's call it time sharing, and when you're not using the apartment for your own personal effect, then you rent it out using Airbnb, for example, which could be very lucrative, but very expensive from a tax perspective, because again, tax authorities would absolutely claim that this rental income is business. That would mean not only that you would pay the marginal tax rate in Israel, it would also mean that you need to open a tax file in Israel. And just to be clear, You do not need to open up a tax file in Israel for simply owning property in Israel. Owning property in Israel does not require you to open a tax file. Renting out an apartment as part of a business scheme, that would require you to open up a tax file. So it's a totally different perspective. And then there is also the possibility, which is more remotely, that if you rented out the apartment as part of a business, that someone may claim that even the sale of the property may also be business. That is, of course, a much I wouldn't say that that's a high exposure, but we had situations where tax authorities claim that it's part of a business and therefore the sale may be taxed as a business.
So not the best way. This is not the best fact pattern. I mean, this is like you say, the highest, and it's a function of them just being foreigners and not having any
foreigners and renting short-term lease. Yes, that from a tax perspective, that's the worst case scenario. Absolutely.
Okay. So then the second scenario that we see, hopefully this will be a little bit better. A middle-aged US couple who are thinking seriously about making Aliyah in the future. They're not ready for that yet, but they might have adult children already living in Israel. And so they want to spend more time there. They want to have their own place. And again, they're not making Aliyah yet, but eventually that's something that they think they'll do. So what are the things that they should be thinking about from a tax planning perspective? This couple is probably spending more time in Israel than our earlier example. So any residency tax and residency issues that they should be thinking about, walk us through that.
For sure. So first of all, I will say when it comes to residency and tax residency in Israel, it's a whole different subject that I'll actually be very happy to have another webinar with you to go through because it really is need to get in depth on so many issues. In a nutshell, I will say the problem today with determining residency in Israel is that it's based on a material test, which is your location of center of life. And location of center of life, of course, as it is a material test, causes, in many cases, disputes between taxpayers and the tax authorities on whether or not you actually shifted your center of life to Israel. There is a presumption of days, and it has two categories. And if you meet those categories, you are presumed to be an Israeli resident. But it's a presumption that may be disputed by both the taxpayer and the tax authority. One is 183 days during a tax year. A tax year in Israel, similar to the United States, between January 1st and December 31st. If you exceed 183 days, you are presumed to be an Israeli resident. And there is another category of presumption of days, which is spending 30 days a year during a tax year in Israel. And overall, during the examined year and the two consecutive years, you spent 425 days in those 3 years. And again, those are presumptions. And that means that even if you find yourself spending less than 183 days, let's suppose 150 days, tax authorities in Israel may absolutely still claim that your center of life has shifted to Israel. Center of life would be based mostly on where is your permanent residency, where is your family, where are your economic and social ties, etc. Having children, for example, here, and especially having grandchildren here, may absolutely be one pillar in determining center of life in Israel, even if you spend less than 6 months in Israel. So that's an issue. There's also the issue of the double taxation treaty when it comes to the 183 days, for example. But let's suppose that you become an Israeli resident. So as we said, then you may enjoy two separate reductions in the transfer tax, which may be very substantial if you personally moved it. One is the reduction that is applicable to your first purchase of a residence. In that scenario, the brackets start at zero on the first 1.9 million shekels, and you have the brackets go all the way up to 10%, but only when you reach 20 million shekels. So, for example, when we discussed a purchase of an apartment at $1.5 million, the purchase tax for an Israeli resident who purchased his first residence property in Israel would be $41,000 and not $120,000 if you purchase it as a foreign resident. And then the other level of reduction, which is very, very lucrative today, after a change in law a year ago, is with regard to the new immigrant or Ole Chadash reduction of transfer tax. If you meet certain criteria, then you may find yourself on the $1.5 million to pay only $4,000 of transfer tax, 0.28%. So that is discrepancy that you ought to look into. Now, what happens, like you said, the parents still do not want to move. The mother usually wants to be closer to the grandchildren, but they still have work. They're not
there may be
yet.
there may be grandchildren in the U.S. also, which is what we see very often.
Of course, that happens a lot. Correct. So they still want to be on the line, but they want to enjoy the reduced transfer tax. So if possible, not always the situation, but if possible, the children who made Aliyah can become the owners. So you can gift the children and give them the money to purchase their apartment as new immigrants, and then they may be able to enjoy the reduced transfer tax of Olim Chadashim.
So you're saying they may be able to take advantage of the fact that they have children there that have become residents and let the children buy the real estate. How many years does the benefit for Olim Chadashim, how long is that available?
Right. So the conditions for new immigrants, first of all, you have 7 years from the time you became an Israeli resident.
Okay.
If 7 years have elapsed, that's it. It's done. You're no longer eligible for the reduced transfer tax for Olim.
Okay.
And also you need to move to Israel within a year from purchasing the residential property. Now, that was the rule a year ago, and it changed now to include the ability to, instead of 1 year, you have 3 years to move to Israel, but only if you purchased an apartment from a contractor that did not build the apartment yet. They did not complete the building. And you have 3 years from the date you purchased the apartment, or when the apartment is complete, whichever comes first, to move to Israel. So that before the change in law, it was a real issue. You had 1 year to move to Israel and become an Oleh. And if you haven't, you lost the exemption or the reduction. And that is even if you bought it from a contractor and the apartment was not ready. So that was a real hassle for new immigrants. So that has changed. Usually in 3 years, contractors would complete the building of an apartment. If they don't, you will still need to move here and wait until it's complete in order to enjoy the reduced transfer tax.
So the timeline is you would make Aliyah before you entered into the contract, but you have 3 years until, let's say, for instance, the building is being constructed until you actually have to move. But you have to make Aliyah before you enter into the contract.
Correct. Well, you have 1 year. So within 1 year from signing the contract,
I see.
You have to go through the Aliyah process and either get a Oleh certificate or a visa. Visa is simpler to get. You don't necessarily need to live in Israel to get the visa. It just means that you're starting the process. And if you get that visa, then you may be eligible for the reduced transfer tax.
So these benefits would be available if you don't officially go through the Aliyah process, but you do spend enough time in Israel and you've moved your center of vital interest to Israel to be
No,
considered a
so
resident.
so
Okay.
yeah, so this is a very, very important point. You must go through the process of Aliyah. You must either
Okay.
get a visa or a certificate of Aliyah. Otherwise, you will not be eligible for the reduced transfer tax. You may
Okay.
be in, you may enjoy the reduced transfer tax on the first apartment, but as you see,
I
it's
see.
not as lucrative.
That's the 40,000 number that you mentioned as opposed to the
Correct.
40,000 transfer tax number.
Correct. And
Got it.
I'll say, and I'll tell you another pointer, which is very, very, very important to note. The Aliyah reduced transfer tax may be enjoyed even if you have more residential property in Israel. So it could be your fifth apartment, and you
Huh.
can enjoy the transfer tax, the reduced transfer tax on that particular apartment. It doesn't have to be your first purchase. One
Okay.
other thing that is very important to note, people who are aware of what's going on in Israel a year ago, you would enjoy the reduced transfer tax of new immigrants only if you use the residential property for your own dwelling purposes. If you did not use it for your own dwelling purposes, then you would not enjoy the reduced rate. That has changed a year ago. You can purchase the apartment and it could be for investment purposes. You do not have to live in that apartment in order to enjoy the reduced purchase
Wow.
tax.
So that speaks to anyone who may have been buying real estate in Israel, not yet ready to make Aliyah, have bought more than one apartment, and
Mhm.
on one particular transaction around the time when they're looking to make Aliyah, even if it's not the place that they're going to end up living in, they can get that benefit, which is pretty
Correct.
flexible, and that sounds like a very generous tax benefit. We don't have
For
much
sure.
time left, so I just want to talk about investors because we see that
Sure.
also people who are looking to diversify their portfolio sort of outside of U.S. real estate market and invest in Israel real estate, like from either a development perspective or to buy several units to rent out. What do they need to be aware of from whether it's from a purchase tax, from an ongoing rental tax income? Like, what are the areas that they should be aware of?
Right. So first of all, purchase taxes, as we said, residential, if it's part of an investment scheme with others, so usually the residential purchase tax would be on the high brackets, 8% and up. If it's commercial, by the way, then it's reduced to a flat 6%. So from that perspective, sometimes investing in commercial real estate may be more lucrative, at least at the beginning. Um, you need to be aware of the different types of investments you may join. It could be you have funds that invest in real estate. Those would usually be publicly traded funds in Israel. There are also other groups that you can join into as part of an investment, whether as a mezzanine loan that you may provide to a project in Israel that could be very lucrative. Always need to look into both the US and the Israeli perspectives on what does it mean when you get the upside, whether it is the interest, whether it is dividend if you invest through a corporation, or whether it is um, purchasing the apartment directly, owning it, and then paying maybe only capital gain tax at 25% to 30%. So in some cases, you have withholding tax rates in Israel, and then you look into the US, and you would usually get the foreign tax credit on the taxes you paid in Israel and pay only taxes in the US. Sometimes you need to look into more elaborate situations. If you have losses here in the US and you want to offset them against gain, then the Israeli taxes become much more important, for example. So it's very, very important when you decide to invest through these types of mechanisms to make sure that you do it correctly, use the right feeder, and be very scrutiny on what type of taxes you may find yourself paying, depending on the type of investment.
I think also what I've seen is investors that there's a benefit, and I'm not familiar with the detail, but I know if you're developing real estate in Israel and you commit to holding on to the developed units and rent that out over time, there's some type
Yes,
of significant tax break.
correct. And I'll be honest, it's you need to be the investment has to be a very large investment. It's usually buildings or building blocks that you are prepared to rent out for a period of at least 10 years. So you need to take that into consideration, that the ability to finance the purchase and getting the upside only on monthly rental is an issue that you need to contend with. The tax breaks on those types of investments, though, are very lucrative. You may find yourself paying half the capital gain tax or half the dividends if it's a corporation, half the dividend tax on corporation. So it could be very lucrative. You need to be very careful when you enter into this type of investment, though.
And what I've
One other
seen is,
thing,
oh, I was just going to add on that, where there's a lot, like you say, there are financing costs, there are other,
yes,
costs to consider in order to get that tax break. But then if you're a US person, that income is all coming back to the US and may anyway be taxed in the US at a higher rate. So you've gone through this entire process, you've committed to holding on to this real estate, which has financing costs, all to get a reduced rate of tax, not thinking, wait a second, you're paying that tax in the US anyway. So it's something to think about, from a cross-border tax perspective. Like, we can't just look
absolutely
at the Israel tax, you have to really just look at the global tax picture.
correct. Absolutely.
I think this kind of brings us to the the Q&A section of our webinar. I do see a question here, Boaz, addressing what happens if the property is owned by an Israeli corporation. Is there any difference in how it's going to be taxed? Anything to think about there?
Sure. So look, corporate tax in Israel is 23%. And then you also add or top it with dividend tax. So if you're a US investor, there would be corporate tax. And then Israel would also, if you're an individual in the United States, under the double taxation treaty, Israel will withhold 25% on the dividend. If you're a corporation holding a corporation in Israel, then it's reduced to 12.5%. And then you, of course, need to contend with the US taxes on that.
And would all of the purchase tax, would that apply if like you were working with an Israeli corporation to purchase the real estate? That would still be relevant.
Right. So corporations in Israel, the transfer tax on non-residential is 6%, and on residential starts at 8%, just like a foreign resident.
Okay. And I would say, just layering on the US piece, if you're a US person that owns an Israeli corp that owns Israeli real estate, you're dealing with our controlled foreign corporation rules. You might be
Yes.
dealing with Subpart F, you might be dealing with what used to be called GILTI or global intangible low taxed income. Now we call it net CFC tested income. So it's much more complex on the US side when you introduce an Israeli corporation.
Mhm.
There's another question around mortgages in Israel and what that might look like for an individual looking to buy real estate in Israel. Is it easy to get a mortgage? What are the common, rates and conditions that people can expect if they want to finance a real
Right.
estate transaction?
Yeah, so basically, and this is not a tax issue, but
Right.
generally speaking, yes. So on the first residential, you may get a mortgage of up to 80% of the value of the purchase, not including the transfer tax. So make sure that the 80%
Yeah.
would only finance the purchase price without the transfer tax. If you're purchasing from the US, that means another 8% you need to contend with, which will not be covered by the mortgage. If it's not your first residential, then under the regulations of the Bank of Israel, mortgages cannot exceed 50% of the purchase value. If it's commercial, of course, it's a totally different story, and it may vary. Usually the interest rates today would range at approximately 4%. But again, it may fluctuate depending on
And how
many,
many
many,
years?
many, many, many issues.
In the US, we have like a 30-year mortgage, I think is common, and I've heard conversation about that going up to 40.
Huh,
Which is a little crazy if you think about it.
it is.
What's the most common term?
It may vary. It could
Yeah,
be 10 years, and also it could be 30 years. And
could
banks
be.
are willing to provide mortgages for 30 years. That's not a problem.
Okay. Great. And I think that brings us to, the end of our session. Just in closing, I mean, we see sophisticated families, high net worth, sophisticated taxpayers making mistakes in this market, like when they cross into Israel and acquire Israel real estate. And it's not because they're being aggressive. It's more so because they're coming with like their U.S. tax instincts, and it's a very different system. So what
Yes.
what what would be your takeaways in closing? What would your advice be at a high level to
And
that
look, we had
audience?
only 45 minutes for this. There are so much issues to cover. For example, what do you do with trusts? And so I really think we need to have more
And
webinars like
yeah.
this and get into more issues. But uh, for your question, I would say three things that are very, very important here. One is you need a team. And when I say team means you need a practitioner who is familiar with the tax system in Israel and a practitioner in the US. And the reason you need a team is to make sure that you don't step-toe on each other and that everything aligns together to make sure that your taxes are most effective when you decide to invest in Israel. Second thing that you need to take into consideration, each advisor should understand what the other is assuming. So you need a team not only of one US, one Israeli, but those who know how to work together. It's so important when your team knows how to talk to each other and it's not in cross-reference between one another. They both understand what happens. US practitioner has a sense of what goes on in Israel, or even more so, like in your situation, Chaya, which is always a pleasure, and your Israeli practitioner who needs to know more than a lick of US tax perspectives. And then finally, rule of thumb, most mistakes happen before contracts are signed. So I urge anyone who is planning on investing in Israel, purchasing real property in Israel, moving to Israel, consult before. Consulting before would save you a lot of money. It's guaranteed.
Okay, great. So firstly, Boaz, as you keep teasing, there will definitely be more webinars on, activities, cross-border, U.S., Israel, cross-border activities. So look out for that. But your advice is get a good team that talks to each other and get that team early. So
Yep.
thank you so much, Boaz. It's been a pleasure speaking with you and having
Yep.
you on our webinar today. And we look forward to future conversations.
Thank you, Chaya. Thank you, everyone.
Thank you, everyone, for joining us.